This lesson 4.7 is on the money market and understanding how money supply and money demand determine short-run nominal interest rates. So we discussed this a little bit in class already, the idea of liquidity preference and how much you want to keep your assets or your things of value in cash. So if you have money, how much of it do you want to keep in cash as opposed to putting it in an interest-bearing savings account, which would then be considered not part of M1. So we looked at the graph for the asset demand for money. And this graph is always going to be about M1. So just to be clear, it's always going to be, when we talk about money and the money market, we're talking about the market for M1. We're talking about liquid money, spendable form. We're talking about cash, or you could say currency and coins. And we're talking about non-interest-bearing checking accounts, also referred to as demand deposits, right? Same thing. Money that you can spend right now, you don't need to withdraw it. Things that do not earn interest. So there's an inverse relationship, of course, between the interest rate and the demand for forms of money that aren't going to earn interest. Because when the interest rate is high, people would rather put their money or their value, their asset, in something that's actually going to take advantage of the interest rate. So high interest rate, low asset demand for money, right? And low interest rate, we're going to have a much higher asset demand for money. We also talked about in class the fact that there's also a transactions demand for money, and the transactions demand for money is related not to the interest rate, but to the nominal GDP or to price level in real GDP. How much money do we need to actually buy and sell, make the trades that we want to make in the economy? So things that will change money demand, if we consider this the total money demand curve, right? Not just the asset money demand curve, but the total money demand curve that includes asset and transactions demand. Things like a change in the price level, for example, will shift money demand to the right, because if prices go up, then people need more money, right, to be able to buy the things that they want to buy. So money demand would shift to the right. If prices fall, if there's deflation, then money demand would shift to the left. Real GDP, same thing. If you need more money to be able to buy the things that you're going to buy because suddenly the economy is improving and real GDP is up and everybody is spending more money on vacations and cars, then there's going to be more demand for money if you need more money to buy the things you want. The last two, technology and institutions, are a little bit trickier. One way to think about it is if people are getting paid, for example, more frequently, if there's a more frequent pay period, then there's going to be a greater demand for money. Whereas if people are getting paid less frequently, there will be less demand for money. So those sorts of things are going to alter the money demand. This is really probably the very most important slide to look at in this particular lesson, and that is the actual money market. And when we draw the money market, the y-axis is going to be the nominal interest rate. Sorry, nominal and I got sort of crammed together there. But the nominal interest rate in the economy, so not the real interest rate. That's going to be a different graph, which we're going to talk about in our next session. But in the money market, the nominal interest rate is the y-axis, and the x-axis is the quantity of money. And this is where it's really, really, really important to label, right? Because we already have currency markets where we're going to have quantity of US dollars, right, and the price of $1. That's not what we're doing here. Okay, we want to really distinguish this, and we'll talk more about that in class, about the three different kinds of graphs that deal with money. This one is, when we say the money market, we're talking about the market for M1, the market for liquid currency within our country. So the x-axis is the quantity of money, and the y-axis is the price of money, which is we're going to call the interest rate. We're going to refer to it as the nominal interest rate. Okay, sometimes people write it as NIR like that. That's also an acceptable abbreviation. Nominal interest rate. So you can see we have here on the middle graph, this should look familiar. This middle graph is the asset demand for money. It's what we were just talking about, right? Asset demand for money, or asset money demand. High interest rate, nobody wants any money. Doesn't mean nobody really wants money. Nobody wants M1, right? High interest rate, nobody wants M1. They want to shove all their money into savings accounts. Low interest rate, right? Lots of people want M1. The one on the left is the transactions demand for money, and that is determined by extraneous numbers, extraneous circumstances. It's determined by the GDP, so it does not connect to the interest rate. We know what it is. In this particular case, it's $100 billion is being demanded because that's how much people want to buy and sell. So that will be added to the asset demand for money, and you can see over in this graph that, for example, if you look at the first graph, at a 10% interest rate, people wanted $100 billion of transactions demand and no asset demand for money, so we get that point. At IE, which is 5% clearly here, people still wanted $100 billion of money for their transactions, but now they want another $100 billion for their assets, which is why they want $200 billion here. So you can see we're just adding horizontally the different types of money demand. All right, so again, I'm going to be labeling money demand and money supply MD and MS, which is slightly different from what this graph shows. Either way is fine. If you like using subscripts, you can do that. The last graph now, if you look at this, it has not just the added together all of the demand for money, right, transactions and asset demands for money, but it also has on it the money supply curve. The money supply curve is a vertical line, and I think the easiest way to understand it is just to say the Fed decides what it is. The Fed decided money supply is going to be $200 billion, and that's what it is, and it's not related to the interest rate. So there you go. There's a money supply curve. It's the intersection of money supply and money demand that are going to determine what the interest rate is. So if we look at this next graph, okay, this says the Fed causes shifts in the money supply. How do they do that? Well, we just learned about the ways the Fed causes shifts in the money supply, right? We just did that by looking at the Fed's monetary policy tools. So what is it that the Fed does? Well, for example, the Fed could raise or lower the reserve requirement, or the Fed could buy or sell bonds. So let's imagine that we're facing a recession and we have this money supply right here. We're going to call this MS1. This is our money demand curve based on the size of the GDP and the asset demand for money that people have in this particular economy. And the Fed decides that we need an expansionary policy. Okay, so the Fed decides to buy bonds. Okay, they decide to use open market operations. As we saw yesterday, buying bonds will cause an immediate increase in the money supply, plus, with the banking system, a greater expansion. So what we'll see is a shift to the right in the money supply. Okay, so we end up at MS2. Well, if prevailing interest rates in the economy stay the same as they were, okay, right here, at that old interest rate, there is now going to be a surplus of money. Right? There's going to be a surplus because at that old interest rate, with this money supply, right, there's not enough money demand, and people are going to want to shift their assets into other places. So what's going to happen with that surplus of money is it's going to be resolved, as all surpluses are, by a drop in price. So if the Fed increases the money supply, notice that the consequence of that is that the interest rate will drop. Okay, that's a really important feature to notice. Similarly, if the Fed decides to decrease the interest rate, okay, then we're going to have the same thing. So let's say instead of buying bonds, the Fed decides we're just going to drop the interest rate. The current interest rate, 5%, we think it's too high. So rather than buying bonds, they simply change the discount rate. Okay, now what's going to happen is the Fed is going to set a new interest rate. Okay, it's going to function kind of like a price ceiling. Now at the new interest rate, what's happening? Right? At the new interest rate, the demand for money is greater than the supply of money, so there's actually a shortage here, right? So either the actions of individuals based on their money demand is going to actually drive the interest rate back up, in which case the Fed's plan won't work, or in order to make that sustainable, the Fed's going to have to let the money supply itself increase, which can happen by essentially bank lending or by people transferring their money themselves from savings accounts into checking accounts or taking money out as cash. So if the Fed sets a money supply, interest rates will follow. If the Fed sets an interest rate, the money supply will follow. Just real quick on that first point, if the Fed decides to shrink the money supply, if we're experiencing inflation and the Fed decides to shrink the money supply, you can see that what's going to happen is that, again, I went to the end point first. Okay, if the Fed decides to shrink the money supply at the existing interest rate, we will have excess demand for money, which will drive interest rates up. Okay, so we'll end up at this new equilibrium point. So the Fed can manipulate the money supply or the interest rate. What the Fed cannot do is arbitrarily decide to move the two things in an incompatible way. So if the Fed were to decide, well, we want to have a larger money supply, okay, we want MS2, and we want the interest rate to be 7.5, okay, they can't choose that point. Okay, that is not attainable because that is not in line with the money demand curve for this economy. So they can choose a larger money supply and get a lower interest rate, smaller money supply, get a higher interest rate, or they can manipulate the interest rate and then have the resulting change in money supply. But they can't do the two things separately at cost purposes. Okay, so this is really important, and we're going to look at this a little bit more on the money market graph. But these are the policies for dealing with recession and dealing with inflation. And you can see there's a few steps here. So an easy money policy during recession, you're fighting unemployment, etc. The steps we talked about already, that you can buy bonds, lower the reserve requirement, lower the discount rate. Excess reserves in banks will increase, very important, right? The banking system is involved. The money supply will increase, as we just saw, right? If we look at the money market graph, okay, we have money demand, money supply, nominal interest rates, quantity of money, okay? Money supply increases, interest rates fall, right? What we just talked about, interest rates fall, and then this key step, okay? Investment spending increases. And that's because when interest rates fall, right, think back to our investment demand curve. When interest rates fall, there's a higher quantity of investment demand. And because investment demand increases, aggregate demand increases. So this is key to a Keynesian version of monetary policy, and then real GDP will rise. Similarly, if the problem is inflation, we want to use a tight money policy. The Fed could use the policies we've talked about already, selling bonds, increasing the reserve ratio, or increasing the discount rate. So one of these things, okay, excess reserves will dry up. Banks won't be able to make loans anymore. The money supply will fall. Okay, so I'm just going to draw this over on that same little tiny graph. Money supply falls, now interest rates go up, and when interest rates go up, what's going to happen to investment demand? Investment demand will fall. Less investment spending means less aggregate demand, okay, and inflation declines. So that's a very quick summary of how the money market is structured and how we use it to help explain expansionary and contractionary monetary policies. And that is the end. You should be able to do the money market activity based on those notes.